All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each of these podcasts. Nothing in this podcast should be taken as investment advice. James and I could have positions in any of the stocks that we mention, and we reserve the right to change our positions at any time without notice. So make sure you do your own research and consult with a professional before making any investment decision. With that being said, the topic of today's video is going to be Plug Power. Plug Power, if you didn't know already, is a startup engaged in the hydrogen energy industry. We've talked about Plug Power and the hydrogen industry in general before on our channels, and specifically why we think the general hype around Plug Power and hydrogen in general are a bit detached from the technical and economic realities of the industry. And so today we're going to be talking about some recent developments specific to Plug Power, including a massive equity raise that they've been forced to do in order to survive. But just a quick recap for those who aren't as caught up on the story of hydrogen power. We'll just quickly recap what the hydrogen industry is all about. So hydrogen energy, contrary to kind of popular opinion, popular belief, is not just one thing. All hydrogen power is used to create electricity for things like electric vehicles, regular electricity production, etc. But it's all about how the hydrogen itself is produced. So currently there are three general ways that hydrogen can be produced in the first place. The first is called so-called gray hydrogen, which is basically hydrogen that is produced by splitting apart the molecules of various fossil fuels, such as natural gas. This type of hydrogen is by far the easiest and most efficient way to produce hydrogen, and can be used to actually produce electricity, to produce the energy. However, because it uses those fossil fuels, it is not a clean source of energy. The second type of hydrogen is called blue hydrogen, and this is basically the same as gray hydrogen, except it uses special techniques to capture the carbon emissions from the fossil fuels so that to make it a cleaner source of energy. And finally, we have green hydrogen, which is the only real clean type of hydrogen. And that's created by using renewable energy sources such as wind and power to create electricity, which is then used to split apart water molecules to produce the hydrogen. The problem with green hydrogen is it's extremely expensive and inefficient to produce that type of hydrogen, and therefore its only use is as energy storage, in which case it's competing not with other energy sources, but instead with like electric batteries. So because gray and blue hydrogen are not truly green or renewable energy sources, and green hydrogen is a lot more expensive and inefficient for energy storage than traditional electric batteries, to this day, there has been no economically viable large-scale application of any type of hydrogen. The only applications that we've seen to date are highly specialized niche applications with very strict technical specifications, or applications that have been heavily subsidized by governments, or in the case of Plug Power, where Plug Power subsidizes its own customers like Amazon and Walmart to use Plug Power's own hydrogen at subsidized prices. Other than that, there's been no economically viable large-scale use of hydrogen. So with that being said about hydrogen in general, I'll turn it over to you, James, to talk about what's happening with Plug Power specifically in the past few weeks.
Yeah, so for today's video, we're going to look at the recent developments that have happened to Plug Power over the past few weeks. And the most dramatic news that we've had was on July 19th, Plug Power did an equity offering where they sold 79 million new shares at the price of $2.54 each. So this allowed Plug Power to raise $200 million of gross proceeds, which they needed because they were running low on cash. And this 79 million new shares that they issued resulted in their total share count to increase by 10%. That means that existing shareholders were diluted by 10%. Now, $200 million sounds like a lot of money, but we have to put that into the context of how much money Plug Power burns. So in the most recent quarter that we have an earnings release from, which is the first quarter of 2024, Plug Power had free cash flow of negative $266 million. So at the current rate, Plug Power is burning $266 million per quarter. So this $200 million that they just raised from the equity offering, that's only giving them about 1 quarter's worth of cash burn. And that means at the current rates, to sustain their current level of cash burn through equity issuance, they would have to increase their share count by 10% every single quarter, which is an extremely fast rate of dilution and is almost certainly not sustainable in the long run. And the reason why this is not sustainable in the long run is that as you issue new shares, the supply of shares on the market increases, which just based on supply and demand dynamics often will push the share price down. Also, when any company has to issue new shares to the market, investors often take this as a negative signal because it shows that the company's not doing too well. They're burning so much cash that they have to keep coming back to the equity markets trying to sell more shares. So it's almost all equity raises are almost always viewed negatively by the investing public in general, and Plug Power is no exception. On July 19th, when they announced their equity offering, Plug Power's share price declined by 15%. And we can see that over the past 1 year, Plug Power's share price has declined by 80%. And this dynamic can lead to something of a death spiral where the company is obliged to issue shares to raise cash to survive, right? But as they do that, the share price keeps going down. And as the share price declines, in order to raise a given amount of cash, they now have to issue even more shares. So over time, as the share price keeps going down, as they do equity raises in the future, the number of shares that they have to issue in each new equity raise also increases. And this can often create a situation where the share count will increase exponentially as a result. And we can already kind of start to see this with Plug Power. If you look over the course of 2022 and the first half of 2023, Plug Power's share count stayed roughly stable at around the 600 million level, 600 million shares outstanding, because at that time they still had a lot of cash on their balance sheet, so they didn't need to go out into the market to do big equity raises. Now, by the fourth quarter of 2023, that's when Plug Power started really running out of cash, and they were obliged to start doing these large equity raises. And now as the share price has gone down, they have to issue even more shares. And after this 79 million new shares that they just issued in July a few days ago, their share count will have increased to well above 800 million. So we can start to see what could be, if things continue at the current rate, what could be the beginnings of an exponential increase in the share count. And when that happens, the stock price, in a lot of cases, will go down very quickly. So in addition to this equity offering, which was viewed very negatively by the market, there was at least some positive news that Plug Power was able to announce recently. So on June 28th, they announced that their hydrogen production facility in Georgia received approval that they are qualified to start receiving subsidies under the Joe Biden's Inflation Reduction Act that was passed a couple of years ago. And so the Inflation Reduction Act gives a $3 tax credit per kilogram of green hydrogen that you produce. And this is Plug Power has been talking about this $3 per kilogram production tax credit as a huge benefit for them, which will help them to achieve profitability. So this is a direct quote here from Plug Power's press release. They said, "In the case of Plug's fuel operations and sales of fuel to customers, this benefit will provide a meaningful reduction in the company's fuel costs. This benefit is one of the key factors that will enable Plug to drive overall fuel margin to a break-even run rate by the end of this year and position Plug for growing positive fuel margins in 2025 and beyond." So as Ryan was alluding to near the beginning of this video, Plug Power subsidizes its customers. So its customers are like Walmart, Amazon, and a few others who have hydrogen-powered forklifts. And Plug Power sells them hydrogen fuel at below cost. And it has to be at below cost because because if there was no subsidization, hydrogen fuel would not be economically viable compared to alternatives. So Plug Power has been subsidizing its customers by selling the hydrogen fuel at below cost. But now, because of this production tax credit, Plug Power is going to get a $3 tax credit per kilogram, and they say this is going to allow them to become profitable. Well, let's dig into the numbers and see whether or not this is actually going to be the case. So the production tax credit gives up to $3 per kilogram of subsidy for each kilogram of green hydrogen that you create. And $3 per kilogram, there's 1,000 kilograms in a ton, so that's $3,000 per ton. Currently, Plug Power operates 2 facilities where they create their own green hydrogen. They have one in Georgia, which produces 15 tons of hydrogen per day, and they have another in Tennessee, which produces 10 tons per day. Additionally, by the end of this year, they claim that they're currently working on a new facility in Louisiana, which will produce 15 tons per day, and they claim that that will be finished by the end of this year. So these are the 3 facilities that they're going to have by the end of this year. Now, based on Plug Power's press release, it looks like only the Georgia facility so far has gotten approval that it indeed qualifies for the $3 tax credit, because there's a bunch of very specific qualifications you have to meet to qualify for it. So if we just look at the Georgia facility, it produces 15 tons per day. If we multiply that 15 tons times $3,000 per ton, the Georgia facility could be eligible for $45,000 per day of the production tax credit. And if you take that for a quarter, $45,000 per day equals $4 million per quarter. And if we assume that's just the Georgia facility, which has already been approved for the tax credit. Now let's just give the benefit of the doubt, and let's say that all 3 of these facilities, the Georgia, Tennessee, and Louisiana facilities, are all going to be approved for the tax credit. Well, that'll be 40 tons per day of green hydrogen at $3,000 per ton. That would be $11 million per quarter of total subsidies that Plug Power could get from all 3 of these facilities. So the total benefit that Plug Power could get based on these 3 facilities is $11 million per quarter. Is this enough for Plug Power to become profitable? The short answer is no, and not even close. So in the first quarter of 2024, which is the most recent quarter that we have an earnings release for, in Plug Power's fuel deliveries segment, they recorded a gross loss of $40 million. On a consolidated basis, Plug Power reported a gross loss of $159 million. But if we even just looking at the fuel segment alone, so this is how much money they lose by selling fuel to their customers at below cost, they lose $40 million per quarter of a gross loss from their fuel deliveries. And then they might get this $11 million benefit from the production tax credit. Well, they'll lose less money, but they're still going to be losing money, right? If you take the $40 million loss and then you get an $11 million benefit, well, then your loss goes down to $29 million of loss, but you're still at a loss. And then the final thing that maybe people who are bullish on Plug Power might be optimistic about is we talked about this in our previous video as well, but we'll just touch on it briefly again here. They indeed received conditional approval for a $1.7 billion loan from the Department of Energy. And this this $1.7 billion is a lot of money, and people are bullish for that reason. However, it's very important to note that this loan is going to be specifically for the financing of new projects that Plug Power has to build. They can't use this $1.7 billion just to fund their losses on their existing unprofitable projects. They have to use this to create entirely new projects. And based on the poor fundamentals of hydrogen, as we've talked about extensively in the past on this channel, we think these new projects that they're going to be creating, they're creating this project Limestone in Texas, and they have some other new hydrogen facilities that they're going to create with this DOE money. these new projects are probably also going to be unprofitable. And then Plug Power will probably just end up losing even more money. So this $1.7 billion loan from the DOE is not going to solve the fundamental problems of why Plug Power is unprofitable to begin with.
So then why is Plug Power's management so optimistic then, if the numbers just don't make sense?
Well, Plug Power's management has to be optimistic because that's the only way the company can survive. So as we show here, Plug Power is only surviving by issuing large numbers of new shares. So they have to come out and say positive things about the company to convince investors to buy their new shares such that Plug Power can continue to raise capital and survive as a company and continue paying the salaries to the CEO and other senior managers. So that is why when you have a company like Plug Power that's heavily dependent on the equity markets, there's always going to be a positive spin that management tells to investors. Now, in the case of Plug Power, it looks like this is sort of wearing thin, and most investors are catching on to the fact that this is, regardless of what management might be saying, this is a completely unviable business, and we can see that reflected in the share price, which has fallen by 80% over the past year alone. So that's about everything we had to talk about Plug Power today. As always, if anybody in the audience has any comments or opinions about Plug Power, please let us know in the comments section below. And we will see you all on next week's video.